The issue today is tariffs. It's a big change in the way the U.S. is going to interact with the rest of the commercial world. And we start with just a basic summary of what is actually happening with these. And so we've got tariffs being imposed on more than 50 countries. We actually have had tariffs that most countries are exposed to. They're just relatively minor tariffs on stuff coming into the United States as a general rule. Periodically, presidents have imposed stiffer tariffs. Steel and aluminum come to mind under different presidents, but they aren't necessarily universal and held from one administration to another. So we have tariffs of 50% imposed on U.S. products. Tariffs at 10% is the new baseline instead of 2.5. Foreign cars all at 25%. That's an issue of we try to sell cars in Europe that are made here, and they get a very steep tariff, and we allow cars to come in the United States from Europe and Asia with very low tariffs, and that game is now changed and will be negotiated. I mean, these 25% tariffs, we don't personally believe that that's going to last, because every other country in the world needs the United States consumer. And if things aren't priced competitively, those companies in those foreign countries are going to suffer. They're going to lose production. They're going to shut down plants. They're going to have unemployment issues. And those governments are going to say, that's unacceptable. We have to sell the United States. Let's call President Trump and see what we can agree to do. This is going to create reindustrialization of the United States. Apple was the first that I saw announcing $500 million of new plant construction. Now, the plants don't open up tomorrow, but the construction process will begin shortly and is going to generate construction jobs, and then it creates employment running the factory for whatever products they decide to build. What has not yet been finalized in Congress are the tax cuts, which are expected to be the largest in history. So there is an argument that tariffs will increase prices. But if we look at Walmart, and everybody shops at Walmart at least once a year, when you look at the product in there, where it comes from, huge amounts of it come from Asia. And Walmart basically says, we're not going to pass your cost on. You're going to have to eat the tariff costs. Our job as Walmart is low price product. And you producer, are going to bear the cost of this. And they do, because Walmart is such a big target for their products. They do not want to lose it. So as of today, April 5th, the baseline tariffs go into effect, and reciprocal ones go in on April 9th. And we have had reports in the media that country after country is calling to make an appointment with President Trump to negotiate a level playing field that is acceptable to him. So a lot of what goes on in the market is basically unknown. It's always unknown what's going to happen tomorrow or next week or next month. But what happens with the tariffs is going to be dependent upon how these countries respond to being tariffed. What's this deal? And we haven't seen this before. I mean, the United States has been a pushover. It no longer is. Currency rates are changing. The dollar is dropping. Well, that has pros and cons. It makes imported product more expensive, which means that you probably will be looking for alternatives to see if you can find something made in the United States. For foreign countries, it makes it easier for them to pay back their debt that's based in US dollars, which keeps them financially viable. There's a give and take. Monetary policies and interest rates are changed by central banks. I didn't put the slide in here, but I have one the number of central banks that are expected to reduce interest rates this year must be something around 85 or 90% of them. The ones that are expected to raise interest rates, I mean, it's a handful, and most of them are relatively small, other than Japan, which is finally, since first time since '89, dealing with inflation. They've been in deflationary scenario. That's a problem in China. They've been in inflation. They're now facing deflation. They cannot afford to lose the U.S. as a marketing outlet. Fiscal policies are being changed by central governments in response to these pressures. China's turned around and said, we're going to put a 34% tariff on you. But they don't import that much stuff from the United States, so it's not a big deal. Besides which, they have to have the United States. You put China and Europe and Japan together and try to find any other way for them to sell as much product as they do in the United States, and it does not exist. They are not in a position of strength in bargaining with President Trump. Donald Trump Jr. had a post on X this last week that basically said, I've seen this all my life. The first person to negotiate with the president wins. The last person to negotiate loses. He has no power because the objective's been obtained. So even before all this stuff happened, stocks were already under pressure. This is the S&P, the NASDAQ, and the Mag 7. And they already are underwater as far as the year-to-date returns are concerned. These kind of corrections are not abnormal. They happen all the time. Now, with Friday's change, we moved beyond 10% reduction or correction on some of these indexes. But basically what this chart tells us is that if you look out 1, 3, 6, and 12 months, when these other corrections have occurred over time, the returns are positive. Now, the current pain is not. Perry and I were talking about that before we started today. And we know that when markets tank, even in the short term, the emotional response in an individual household is, oh, what's next? I mean, this can't go on. And it doesn't go on. That's basically what we have learned over time. Now, the other point that Perry pointed out in the first segment was that a lot of other countries happen to provide better returns, and it happens on a regular basis. And this is basically through March 28th, so it's through the first quarter. There are a ton of other places in the world to invest that have been generating positive returns while the U.S. is going down. And that's been reflected in all of our models as our models have shifted from focusing on U.S. markets to international markets and commodity markets. And speaking of commodities, there's been a huge change in the price of copper. And when we look at the demand created by artificial intelligence and the need for power centers, power sources, the utilities to build out more power for the data center development, even though the initial data center development was perhaps a little overly optimistic, it's been scaled back a bit over recent weeks. We still have in our country an outdated generation and transmission infrastructure, and it's going to require a ton of copper. But the easy copper has already been mined. This happens to be an open pit in Arizona, and Donald Trump's tariff policies turbocharged copper prices, and it sent the miners scrambling to work out how to get more metal out of these big piles of what they thought was waste product, just wasted dirt. But there's copper buried in the piles. If it was a coal pile, we'd be saying there's slag in there. But we have towering piles of waste rock, and then they estimate there's 10 million pounds of low-grade copper. So we have steel, aluminum, and copper among the metals that are excluded from reciprocal tariffs by the U.S. So that provides relief to domestic buyers and avoids potential price dislocation. The U.S. is highly dependent on imports from China-dominated supply chain, and Trump wants to boost access to critical minerals. America relies on imports for 80% of its rare earths, nearly 3/4 of its zinc and tin, and more than half of its lithium. That's according to the Geological Survey. And we have tons of lithium here, but regulations won't let us develop it. We expect President Trump is going to do something to change that. Now, gold prices for several months in New York have traded at large and unusual premiums to benchmarks as traders weighed the risk of precious metals that could be caught up in tariffs. So there has been a huge movement of gold from outside the country into the into the Bank of New York, where a lot of countries store their gold. We have watched, well, we haven't seen them personally. We've seen the reports of planes and ships loaded with so much bullion that it distorted the trade data. And on Thursday, U.S. premiums for precious metals tumbled after a list of exemptions from tariffs showed tariffs included gold, silver, platinum, and palladium. So a lot of the movement has been in price has been a function of expecting tariffs, which are not coming to pass. But one of the other areas that has really been disrupted is the green energy. Now, President Trump's been pretty clear that he's going to unwind the green energy scam. But if we just think back a little bit to Obama's green energy plan, and the first thing that came to mind was Solyndra. It was a company that received a ton of money, but there were grants to 22 other companies under that green energy plan, all of which have filed for bankruptcy. Trump's oil and gas policies are causing a shakeup in the energy finance sector. It's a $1.5 trillion business. Wall Street's unanimity on the need to limit climate change is collapsing. They were investing on a theme, and many investors did too. And the whole thing is causing a reset in a $1.5 trillion global market on how to finance energy projects. As White House makes supporting oil and gas, coal a priority, U.S. banks that just a few years ago were vocal in their embrace of net zero targets have changed their game. That includes discussing removing long-standing restrictions on some of the most controversial fossil fuel projects. But many investors accepted the concept of green energy and green power as a way to invest, and it's actually been quite devastating. And this exchange-traded fund, TAN, which invests in solar companies, since its high back in 23, has lost 64%. Big drop through here, a lot of chop, but the trend has been down. This is why, as modern portfolio theory and making commitment to industries because they seem to make sense at the time doesn't make sense over time. One of the other things that's changing is bond yields are falling, and that's a positive for bonds. So the bond market, the treasury market, has been in a bear market for 4 years. And as we've said in prior webinars this year, it looks like this year will be the one where that bear market finally comes to an end for bond investors, as interest rates have fallen back down to 4%. Actually, the 2-year was slightly under 4% on Friday. Part of what's happening that hasn't shown up yet in the Federal Reserve's data is this data from Truflation. And Truflation shows that the actual inflation rate that's going on in our country today has dropped to below 1.5%. Now, the Fed works on lag data, so we think this data is going to show up within the next month or two at the Fed, and they are going to have a much more difficult time maintaining interest rates at the current level. The explanation that Chair Powell made the other day was, we're just going to wait for the data. After all, he didn't say this on Wednesday or Thursday. We're data dependent. That's been his speech for some time. Well, we don't have the data to believe tariffs aren't inflationary, because that's a common theme. But tariffs exist around the world, and where they exist, those countries aren't dealing with inflation. So it's pretty hard to actually argue that tariffs are inflationary when it doesn't happen anywhere else, but it will here. This shows that we've had significant drawdown periods for bonds, bear markets and bonds. And the current one here started in August of 2020, and they've been pretty severe losses, but this is coming to an end. But the fact that it has transpired has not avoided the emotional response of fear. Now, this fear gauge, which comes from CNN Markets, is a factor of 7 different inputs that they use to generate the number. This is pretty bad. The last year was basically neutral, and it has continued to weaken, or fear has increased ever since, due to what's going on with the one with the election, and then with the protests, and now with tariffs. It's just been an ongoing drumbeat that things are going to get worse under President Trump. Part of that's media, but it has caused things to change in the market. And we respond to that with the way we manage portfolios. And it's not just us, which I'm going to illustrate here, but this is where we were last month. We have condition adaptive models. We basically are looking at what is generating returns over a recent data period. Now, as I said, this is not exclusive to us. We track 401k plans, corporate 401k plans for our clients who want to know, what do I do with this money that I'm saving in my company plan? They can't have us manage it, so we give them guidance. Here's how, given the list of assets that you have to work with, what's favored. Here's the Delta Airlines plan. And what's at the top of the list, now our benchmark is we don't like owning things that are worse than cash. And so our benchmark is a short-term maturity corporate paper instrument. This exchange-traded fund invests in corporate notes that mature in no more than 60 days. And on average, they mature in 30, because something's always coming due this week. And when they use that money to buy something, it's going to come due in no more than 60 days. So that's basically our cash equivalent benchmark, our bogey. And we want to hold things that are doing better than that. Everything else below the list is losing money. Here on a year-to-date basis, bonds were clearly improving, but over the last month, they were still negative. So for Delta Airlines, the recommendation was emerging markets, total return institutional, that's a bond fund, and developed international markets as of the end of the quarter. This is Boeing's plan. They have a bigger list, so it's a different universe. Now, what do we have at the top that's above cash? We have short-term bonds, inflation-protected treasuries, international, and international. What do we have at Costco? Nothing is providing better return than being in cash. Here's a federal TSP plan. Had some calls from people who are federal employees saying, all we're in is international. Is that where we should be? I said, yeah. I mean, the call came in a week ago and said, with the market down as much, shouldn't I be buying back into U.S. stocks? Well, not with regard to the choices you have in your plan. This is the universe to work with. we look at our models, and they each have a universe of exchange traded funds to work with that cover these different asset categories. In a 401k plan, you don't particularly have them. If you happen to be an employee of one of these companies, and even if you're not a client, we're already doing this work. We can add you to the list. All you have to do is contact us. And if you're working for somebody else, maybe we're tracking that because we have a client that's there and we already have the work set up. You can contact us and see if that's the case. Now, along with that, we actually manage 401k plan menu and models for local businesses. And with that, we have a universe of funds that currently, based on our annual review for ERISA compliance, has a list of 34 choices in it. And as of the end of the month, the cash bogey was at number 11. So above that, we had those assets to use in our models. It included gold, emerging markets, international markets, gold and silver, bonds, corporate inflation protected bonds, corporate bonds, treasuries, and treasuries. That's a very defensive position. So this was done on the first of the month, which means that except for whatever changes occurred in gold and international, those slipped here this last couple of days. But half of this is in bonds, all of which went up in the last couple of days. Of the models using only these top 10 assets, our relative strength model is divided among the 10 strongest assets if they're above cash, and this is the allocation. Our aggressive model, we call top 5, invest in only the 5 strongest assets if they're above cash. If cash is number 1 on the list, that's what it's going to be. They're going to be in cash. Now, we run some modified modern portfolio theory models, and our process is slightly different because we're never fully invested in everything across the board. We're only invested in the strongest assets. So we are always looking at the macro asset allocation, and we look at what's the strongest asset. In this case, it's gold. So in each of our following models, we put as much as the risk allocation will allow in the strongest asset. And then we put the next most we can based on risk exposure to the next asset, which in this case is international. And then this is emerging markets. And then it was bonds. These two were bonds. And then we got to cash. So our conservative tilt modern portfolio allocation, maximum to the first asset is gold. So we maximize the exposure to gold. And then we maximize the exposure to international. And then everything else that's left over went into bonds. That's the most conservative model. The next one, the moderate model, rule 1, emphasize the strongest asset class, gold. This model only allows 10% in gold. Then we have a higher allocation to international. Everything else goes into bonds. The aggressive tilt model, 20% into gold, then the maximum allowable into international, and then everything else into bonds. How will that change? It will change because the rates of return on bonds slip and U.S. stocks rise, and they will just rotate around. And that's what has generated this current allocation in the models that we run for our individual clients. This is a 10% allocation per asset, but 2 of the assets are foreign value asset allocation. So we've got a 20% slide here, but it's 2 different funds. Global typically has 10 positions. Dynamic can have anywhere from all cash to it's had as many as 15 different positions, but currently this is a 55% cash allocation, which will not last. I mean, it just happened within the last couple of days in response to market changes. But we have no idea what's going forward. We're not in the prediction business. We're in the interpretation business. We track what's happening, and then we adjust to reality instead of pretending that we have 80 years for averages to work in our favor. It means you have to pay attention and adapt portfolios. This is not a job for slackers. The question is, what are you going to do with dynamic markets? I mean, you just have to look at the headlines of the markets over the last couple of days and realize these are not static markets. They're dynamic markets because people react emotionally, even though they may try to focus on fundamentals, focus on data. It's even hard as we deal with the changing data to remain its rules based. Get your heart out of the way, get your emotional response to today's news out of the way, and follow the rules. But once you have rules, you have to make a decision. Someone actually needs to worry, watch, and more importantly, act. You can worry and watch and sit back and do absolutely nothing, and it will not solve the situation. You can do this if you want to spend a little bit of money on software, data, and then the time to pay attention and have the discipline to make decisions. If you don't want to do that, you can talk to us and perhaps we'll take on your account. You have questions, want to talk to us about that, you can send us an email, help@IRI-radio. You can give us a call. We'll actually talk to you. We can actually do an analysis of your portfolio from our risk management perspective without charge and online. And we don't need to know how wealthy you are. All we need to know is what you own. If we know what you own, we can do a risk assessment.